This video is sponsored by Morning Brew. Visit the link in the description below to sign up for their daily newsletter today. It's pretty big news when a company goes public, and for good reason. It often means a big payout for the original owners, and of course, everyday investors like you and me get the opportunity to invest in a new, exciting business. It's not as often, however, that you hear of the opposite happening, where a public company is being taken private. And with news of Elon Musk's offer to buy Twitter, and the following headlines about that possibly not happening anymore, it's led to a lot of questions. How does taking a company private actually work? When will this be a done deal? If I don't sell my shares, will I end up being a private partner alongside Elon Musk? Well, no. Surprisingly enough, shareholders don't actually have that much control over what goes down when a company is taken private. And in fact, management may actively act against the wishes of public investors and fend off attractive arrangements, using everything from poison pills to white knights and golden parachutes. No, those aren't power-ups from a video game. Those are real tactics used by firms to fend off acquisitions. And they can make a seemingly straightforward process of buying a business a bit more confusing. So let's go over how taking a company private actually goes down and all the drama that comes with it on today's Plain Bagel. When we say that someone is taking a company private, it means that a small group of investors, or one really rich individual, is buying up all the publicly traded shares of that public company, delisting them from public exchanges, and becoming the sole owner or owners of that business. That means everyone who owns shares of the business will see their stock forfeited for cash, often at a premium to the current market price, and the acquirer will have sole control over the profitability and assets of that business. Now, I know what you're thinking. Most public companies have tens, if not hundreds of thousands of shareholders. That's a lot of buy orders for the acquirer's Robinhood account, but that's not really how the process works. While an acquirer might accumulate some of their position on the open market, taking a company private often requires negotiating and gaining the approval of the board of directors. If you're unfamiliar, the board of directors is an elected body of individuals that makes key decisions for the business, including how much management will be paid, what dividend the stock will pay, if any, and importantly, whether or not to accept an acquisition offer. The board of directors plays a pretty important role for these public companies. You can't really run a corporation with hundreds of thousands of public shareholders where everyone's trying to fight for control and decide what the business actually does, like a weird internet-controlled version of a Pokemon game. Someone needs to exert control and run the business on behalf of the crowd. And if the acquirer can convince the board of directors that their offer is in the public investor's best interest and is the best offer out there, then the board of directors simply needs to accept the arrangement. So unfortunately, investors don't individually decide whether or not they want to sell their shares. But while you might not be saved a seat at the negotiation table, deals do have to be approved by a shareholder vote. So there is an opportunity to vote against a proposed deal if you aren't happy with the terms, assuming your broker will actually forward the necessary documents to you. Some brokers have weird policies around that, so you'll want to look into that. Deals also require regulatory approval to ensure that they don't raise any antitrust or security concerns. So it can take a few months or at times even years for a deal to get the all clear. But once everything is approved, a closing date will be announced, and on that date, investors will see their shares disappear and magically replaced with cash. But all that is the what of private takeovers. As for why anyone would want to buy an entire public company, there are a few justifications outside of bragging rights and world domination. One is that the acquirer might believe that the company would perform better under their control, especially if they believe that current management isn't realizing the company's full potential. Another would be that they believe public markets are undervaluing the business, and at this price, it's currently a steal. There's also the possibility that they think the company would do better without dealing with all the baggage that comes with being a public company. While going public probably seems like the ultimate goal of any business, and in many cases it kind of is, it does come with its own downsides, including strict regulations, tedious reporting requirements, and all the fees and expenses related to keeping shareholders in the loop. Being public can also distract management from achieving longer-term objectives. Public investors aren't always the most patient lot, and it can be difficult to implement a longer-term project when shareholders are kicking down the door and demanding change whenever the stock price fluctuates. As for how the private owner would benefit from owning this business, given that they can't trade their shares publicly anymore, they can either choose to receive the company's profits as a dividend, so they actually get a cash payout from the business directly, Or they could look to sell the company later down the road once they've actually improved operations. Perhaps even looking to relist the company under the assumption that public investors will now pay a higher price for the stock, or just simply finding another private investor with a lot of money to spare. Now, that's great and all for the acquirer. But what does taking a company private mean for current investors who own shares of the target company? Well, fortunately, private takeover offers do tend to come at a premium to current stock prices, since the acquirer needs to offer something that's better than what shareholders could get otherwise on the open market. So at least at a surface level, a takeover offer is a positive thing for investors in the short term, which is why even rumors of a takeover can send a stock price surging as investors try to get in to take advantage of the expected premium. It is, however, worth noting that these deals aren't always in the investor's best interest and can come with their own risks. The takeover price, even if at a premium to the current market price, may still be well below what investors believe the position is actually worth, and may force some investors to realize a loss when they were hoping to otherwise ride out a downturn and hold the position over the long term. There is also the risk that the deal falls through, and that the stock price falls back to its pre-deal level, something that we're all probably painfully aware of by now with the whole Twitter deal, given the news that Elon Musk has threatened to walk away because of concerns over fake accounts, something that has actually sent Twitter shares below where they were before the deal was first announced. It could also be interpreted as a negative signal that either the buyer found something that they didn't like about the business, or that any offer in the future will likely be rejected because of regulatory hurdles. It's actually why even when a takeover price for a deal is announced, the share price will likely approach it, but won't exactly match the offer price. This discount essentially represents the risk of the deal not happening and offers a return to investors who are willing to buy in, wait, and bear that risk, although there is a time value aspect to it as well. It's for these reasons that the board of directors might actually reject an offer to take a company private, even if it comes with a stock price premium. Management might simply believe that investors will see a larger return over time by keeping the company public and letting these investors hold their shares. Or they might just believe that the deal has little chance of actually closing and is therefore not worth pursuing. There are times, however, where a deal is rejected for more selfish reasons. You see, a private takeover generally means that the board of directors, and possibly even the company's employees and managers, will lose their job. And there are instances where directors and/or managers will not only reject attractive offers, but will actually pursue activities to make themselves harder to get rid of, known as management entrenchment, all to keep their cushy positions at a time where they're supposed to put investor interests first. And it's here where things start to get interesting, because if the acquirer still decides that they want to buy the company, then we enter the world of the hostile takeover, which sounds pretty aggressive, but basically just means that the acquirer will try to circumvent the BOD to negotiate with public shareholders directly in order to purchase their company. So, how does an acquirer buy a business without the blessing of its BOD? Well, there are three primary methods, all of which involve the acquirer voting in new directors to the board of directors to replace the currently troublesome members. The first is open market operations. In other words, they go out and buy a bunch of the stock. So yes, in this case, it is a lot of Robinhood trades. But it can take a long time to gain any meaningful position, and some investors might not be looking to sell, which leads us to the second option, the tender offer. A tender offer is when the acquirer announces that it will buy shares for the target company for a premium to the current market price. So if the company's stock is trading for $10 a share on the open market, the acquirer might buy investor shares for $13. In doing this, the acquirer offers a clear incentive for investors to sell directly to them. But obviously this comes with that cost of that extra premium. Finally, there's the proxy battle. If the acquirer can't gain the majority stake that they need to replace the board of directors, then they might simply campaign to convince other investors to vote in more deal-friendly directors who will accept their offer. If they're successful, then they'll be able to get the directors they need on the board without a majority stake in the company, allowing them to move forward with their private takeover plans. But all the while the acquirer is working through these tactics to try and take over the business, the board of directors is scheming with a slew of tricks to try and slip them up. You see, while major company decisions are put to a shareholder vote, the board of directors still has a lot of authority to make changes without shareholder approval. And so there are a number of tactics that they can use to slow down the acquirer. One such tactic is the poison pill, which Twitter actually implemented briefly to fend off Elon Musk before reversing course. The tactic, which also goes by shareholders' rights plan, gets its name from the deadly pills that spies would take if they were ever captured by an enemy to protect their nation's interests and secrets. And a corporate poison pill follows sort of a similar idea. If a single shareholder ever reaches a certain threshold of ownership specified by the poison pill, then the company will begin selling extra shares to other investors at a discounted price in an attempt to dilute the ownership of the acquirer on a percentage basis, which means taking over the business and getting that majority stake will become much more expensive, albeit at the cost of other investors who will now need to pay to keep their own interest in the company. Another tactic is known as the crown jewel, where a company puts in place a plan to automatically sell a key asset should an acquirer gain too much control, which would clearly discourage them from moving forward. There are also supermajority rules that require more than a simple majority vote to get certain things done, a golden parachute, which provides a big payout to the directors if their business is acquired, and the so-called white knight, where the target company sells itself to another friendly investor before the hostile acquirer has a chance to buy the business. Yes, pettiness goes very deep in the world of investing. So yeah, it's all pretty dramatic stuff. And unfortunately, investors can suffer throughout this whole process. But it is worth noting that just because a company has adopted some of these tactics doesn't mean that they're automatically trying to screw over their shareholders. There are conflicting papers as to how these tactics actually impact investor returns, but in some cases, there are studies that suggest that some of these things, like poison pills, can help BODs bargain for a better deal for their investors. So whether these tactics are good or bad for investors really depends on the case-by-case nature of the deal at hand. Regardless, the whole process is an important thing to understand if you invest in individual stocks, given that any company can effectively be taken private. While the announcement of a takeover bid is generally seen as a positive, and some people do base their entire investment strategy on buying companies that they think will be taken private, it's clearly at times more of a headache than you'd expect. It's also worth understanding for when you see these sorts of discounts in the price of the stock compared to its takeover price, like we're currently seeing with Twitter. While it might seem like free money, there is a reason why the gap exists, and every investor will have to decide for themselves whether that added risk and all the pettiness that comes with the takeover process is worth that extra bit of return. A big thank you to Morning Brew for sponsoring today's video. As you probably know by now, I'm a big fan of my morning readings. Before I hop into my daily tasks, it really just helps me get up to speed on what's going on and the important headlines. And Morning Brew has been a go-to read of mine for a number of years now, even before we were partnering together. They're a publisher of an awesome newsletter that they send out 7 days a week, summarizing tech, finance, and business news. The newsletters are a 5-minute light read that cover all the important headlines of the day. For example, they recently covered why the US dollar is currently almost at parity with the euro, and what that generally means for the markets. If you aren't aware, the last time that actually happened was in 2002, shortly after the euro was first introduced. While the stories are certainly interesting, Morning Brew is also actually pretty entertaining to read. Their writing is very witty, and yes, I admit it, I like their gifs. It's the most humor I get in my job as an analyst, alright? Anyway, those factors combined make for a pretty great way to ease into your workday. And if you'd like to read them too, you can use the link in the description below to sign up. It takes just a few seconds and is completely free, so there's really nothing to lose. So be sure to check out Morning Brew. Thanks for watching. I hope you found this video helpful. If you did, please do make sure to like, subscribe, and all that good stuff. It does really help the channel tremendously. You can check us out on Twitter. We have a Facebook page. It's very small, but you can check those out if you're interested. And let me know in the comments down below what you think of the whole takeover process and what you think of Elon Musk buying Twitter. Thanks for joining me. We'll see you in the next one. Cheers.